All right, guys. Hope you had a great weekend. Starting off right away with Virgin Galactic. They had a solid launch with Richard Branson out into space today. Pretty interesting to watch that. A lot of people are very bullish on this, obviously, but I think it's going to be a selling news event. We've seen it pop numerous times. Again, they're still pre-revenue right now, so next phase would be obviously taking paying customers into space, but who knows how long that takes. It might pop off tomorrow. The expected move is about $13 in other directions. So upside is around 63, downside is around 37. I'm inclined to think we stay pretty flat on the week between 44 and 56-ish in either direction, right? So I'm not touching it at all. I'm going to watch it. If it pulls back down to 40-ish, I might get in for a swing trade, but I'm not really trading it at all myself. So there are interesting ways to play it as well if you want to play it like on the downside given the skew on the puts. So like for example, if I look at the option chain, you can see that you're going out a month to August. If for example I decided to do a put ratio spread, I could for example buy a $40 put option, and then I could sell for example 2 of the $33 put options against that option, right? And basically if I did that, I would have no risk at all. I would have pretty much, either a small credit or a zero debit, in which case, if it falls below 40 to 33, you have maximum upside of $7 for no actual risk. And then obviously, if it pulls back down below 26, that's where you start to lose money, right? So that's an idea right there that I'm also looking at on SPY. So let's pull back to the charts right here again. Back to the chart over here. Looking at SPY, it's very overextended right now. Here we go. All-time highs on Friday, 435.65. In the last month or so, it's gone up about 5%. And we're approaching earnings season now, guys. So I'm inclined to think we rally further into earnings and then come back down after earnings, right? So that's what I'm looking at right now. As I mentioned, though, on the put ratio side for SPY, we pull up the chart here, or the option chain here. We can see that IV is pretty low overall right now. But going out to August OPEX, right? There's a gap to be filled at 400 on SPY. So if you want to take a little bit of risk, but not risk anything if it doesn't fall, what you could do again is a put ratio spread, in which case you could, for example, go long the 420 put and go short two of the $400 puts, right? Now, if you do this, your overall debit will be about 6 cents, right? You need to have a margin account. And obviously, if it falls, much more than this, you could be in trouble. But the idea here is that in a month's time, will it fall more than 10%? Probably not. Could it fall 10%? Sure, right? But the idea here is that you're risking 6 cents. If it does not fall, all you lose is 6 cents, right? Anything above 420, your loss is 6 cents. Anything below 420, you have upside of $20 minus 6 cents for risk of 6 cents right now, right? So your risk would be your risk would be 6 cents, and upside would be $19.94, right? Down to 400. Your break even would pretty much be 380. So it could fall as low as 380 from the current price. If it were to fall 435 minus 380 divided by 435, it would need to fall 12.64% in the next month in order for that to happen. So not a bad idea. It'll tie up some margin, obviously, in your portfolio because you're selling 2 put options, essentially 1 cash secured put, right? But it's not a bad idea to use a strategy like this because obviously if it stays above 420, you lose nothing basically, right? If it goes down to 400, you can make a pretty fat gain overall because you're risking 6 cents, right? Now, obviously, if you don't understand what I'm talking about, don't do this. Maybe paper trade it, understand how it actually works. And obviously manage your own risk, understand that if the market were to crash in the next month, it could be devastating as well because if it goes below 380, that's where you'd start to incur more and more losses as the 2 short puts go into the money, right? But again, the probability of that happening, like right now, the probability of it going below 380 as of now is about 5%. So probability of you not losing money on this trade or losing 6 cents is about 95%. And obviously probability of SPY going down below 420 is only about 24%. So not too great overall, but the whole idea is that you can hedge yourself through earnings season into mid-August, right? Not a bad idea. Same idea can be applied to Qs as well, triple Q ETF, and also IWM as well. Now going back to charts over here, we're going to look at also SoFi. So SoFi I've been looking at for a little while right now. I know Greg's been mentioning it in chat, as well as a few other people, Kevin as well. And I find it kind of interesting because I do think this is possibly the future of finance. They're modernizing it, and I'm looking at it around the 15 area or so. If it gets down there, I want to sell some cash secured puts. Again, a bit risky because they are still a former SPAC company. Looking at the option chain now, let me pull it up. So here's option chain. We can see that for the August OPEX right now, for example, the $15 put options are yielding about $1 credit, meaning that you need to be okay with buying the stock at 15 minus 1, which is 14 bucks, right? So not too bad because you're buying it essentially $2.45 below the current price. Not a bad entry point overall. Again, very speculative, more of a long-term idea. But right now, given that there aren't that many good deals in the market, I'm just looking at interesting plays, and this is one of them I'm looking at right now. Alternatively, looking at AMD again, right? So AMD reports earnings not next week, but the week after. So keep that in mind. We had that nice gap fill down at 88, pulled back down on Thursday, recovered a bit on Friday. This to me looks like one of these patterns over here where we rallied up hard, pulled back down for a couple of days, and then boost up again. So if my thesis holds correct, I think we're hitting all-time highs before the ER, so around 100 before the ER. And this time around, I think that we're going to have a solid move up after the ER instead of a pullback. I've been saying for a while now that we've been consolidating between 75 and 95. Once we break above that range and establish a new range, we'll establish a new range between roughly 100 and 120 or so, right? AMD is very overvalued if you compare it to NVIDIA, for example. And obviously, if you want to figure out why, look at the price earnings ratios and price to sales as well. And you'll see right away why that is, okay? Next off, looking at Apple. So I've been mentioning Apple.
Did you say that?
Sorry?
Did you say under or overvalued? I didn't hear you.
AMD undervalued.
Okay, thank you.
Yeah, no worries. Apple, I've been mentioning for the past few months that it was very, very undervalued. It hadn't really moved at all for a few months since the previous earning report right over here when it hit 137. And what happened on Friday, we hit new all-time highs, right? We hit a high of 145.65, eclipsing the previous all-time high of 145.09. This sets a nice push up for the 155 region. And if earnings are solid like they were last quarter, I expect another boost up to newer highs and establishing a new range, probably between 135 and 155. In this case, it might push up pre-ER to around 150, 152-ish, have a solid report, pull back down again to the 140 area. That would be a decent buy area perhaps if they have a good report, obviously. But Apple is still performing very well. The Fangman stocks are just crushing it. Microsoft, Facebook, Amazon, Google, Netflix, they're all hitting the all-time highs. And that shows you where the money's going to, right? The mega cap stocks right now. So keep an eye on them and obviously manage your risk well. Right now, the IV is high for everything because we're approaching earnings season right now. So keep that in mind when you're buying your calls or puts. I would use spread to mitigate your risk, obviously, or simply wait until after the event itself. Or if you're long-term bullish, long-term being, more than 6 months or a year perhaps, buy leaps instead, buy a year out, right? Why not do that? Trading short-term can be lucrative, but oftentimes it carries a lot of risk with it as well. So keep that in mind too. Lastly, what else do we have on the list here? There was Palantir. We discussed that last week already, not much to talk about there. Oh yeah, there was Taiwan Semiconductor as well, TSM. The TSM has a nice chart formation right here. Good consolidation in the range between 110 and 120. And I see them pushing up to 130, possibly as high as 140 all-time highs in the next couple months. So I was discussing this play with one of my students, and they mentioned they want to go long on TSM. I said, you know, why don't you go long a few months out, right? So looking at the option chain right now on TSM, I'll pull it up. Here it is. You go out to September or October. September right now is 2 months out. Looking at the 120 calls right now, they're about $6. So if it pushes to 140 by September OPEX, you're making about $14 profit or 200% plus return, right there, right? Now, right now, the HV is not showing, so I can't see it right now. Unfortunately, I'm assuming that it's a little bit higher than historical right now, but it should pull back down in the next few days. And that would be a decent entry point for some call options into September. If you want to go longer term past September, I would suggest perhaps going into January instead. And in that case, if you want to go in the money, you can go in the money and create a synthetic position. Like, for example, you could buy January next year call options, 100 strike for $23 per contract, basically paying $3 of extrinsic value, break even is 123. If it pushes again 140, you're making $17 per contract. You're making almost 100% return on your contracts that expire in about 6 months or so, right? More of a passive strategy for those who can't watch the market every day. Again, trading in the short-term contracts, much more risk involved. Obviously, they can be lucrative, but again, if you're not timing your entry points precisely and exiting on the pops, they're not really good to play, right? So I'm going to cut it off over here and do some Q&A with you guys, because I have a little bit of time today. If you like the video, obviously, share with someone else. Appreciate that, and have a great week, guys.